The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday, and we are going to be talking about money. There's a lot to cover today, actually. So thanks for listening. Total Risk is a company that puts out software to evaluate risk in portfolios. And they put out a white paper recently to say there's two questions that every investor should be asking. So I'm going to spend some time today answering those questions. If you have those questions, great, because today I get to answer. You'll also want to hear, I've got a great guest coming today, and I'm going to recommend that you sign up for her newsletter, whether you're 30 or 40 or 50 or 100 or any age in between, because it's especially if you're in a sandwich generation where you still have parents living, still with children, or even grandchildren. You want to listen to what she has to say. We also want to cover, because the advertising rule, the Securities and Exchange Commission has put out a new advertising rule, and there's very big changes coming, in my opinion, needed. I was interviewed by one of the national compliance organizations or companies, consultants, and they asked me what I thought. I don't know if I will be published or not. Maybe. My take could be very different from a lot of others. I think it's a big benefit to prospective investors. But then, isn't most of what I say and do different from the norm? Anyway, let's get started. I want to start asking you, how do you think the Standard & Poor's will do this year? How do you think the markets are going to do in 2021? When I was licensed back in 1986, almost every stockbroker, and that's what they called us in those days rather than financial advisors, every stockbroker, almost everyone had a book, which was essentially a calendar, but on each day of the week, it had information on what was collected and going on. It was called the Stock Trader's Almanac, developed by Yale Hirsch, and you've heard his son, Jeff Hirsch, who is now managing that book and taking care of that book and publishing that book, has it online and also in a physical form. Jeff Hirsch has been on the program a couple times. Everybody said, but every day there's a new statistic. And one thing in which is in the book, which they talk about, is the January effect. And it's fairly accurate. It's not 100%, but it's well over 50. And my guess, it's probably 80 or 90% accurate. And what it is this. As January goes, so goes the year. If January is up, the year is probably going to be up. If January is down, the year is probably going to be down. I remember talking to Jeff. He was on the radio program last February, and I talked to him about the January effect, and it was really kind of inconclusive because the Dow was down, the Standard & Poor's was down, but NASDAQ was up, so it was inconclusive. His conclusion is we were going to have a down year. My conclusion was we were going to have an up year. Who knows? We ended up with an up year, with the Standard & Poor's up 16.3%. But it's not just the entire month of January. The first week of January is maybe 80% accurate in predicting how the fall month is going. So if you look at the numbers for last week, as we finished last week, the Standard & Poor's was up 1.8%, the Dow was up 1.9%, NASDAQ was up 2.4%. Our clients' unofficial estimate were up 6%. So the first week in January looks very good for predicting that the month of January is going to be good, which means that the year should be good. It's not 100% proof, but we'll see how it lays out. So far, it looks pretty optimistic. And last year's returns I sent out in a newsletter this week. And if I'd seen the returns like we saw last year for my client accounts, I would have had a hard time believing it. If it wasn't for my accounts, if I hadn't known they were my accounts, I would have a difficult time believing, because my growth accounts were up 77%, and the profit sharing accounts were up 230%. I have to say about the profit sharing accounts, the profit sharing accounts actually started. It's a new thing that I offered. They started actually on the 1st of April, which was close to the bottom. And if you look at the Standard & Poor's during that time, the Standard & Poor's was up 47%, although it ended as a year number from the beginning of the year to the end of the year up only 16.3%. From the 1st of April until the end of the year, it was up 47%, because during the month of February and March, it was down. Standard & Poor's was up 16.3% for the year, 77% for the growth accounts. That followed the previous year when we were up 45%. So past performance certainly is no guarantee of future performance, that I have to say. And my clients are fully invested the full time. We know that there's going to be times of periodic losses and setbacks and unexpected circumstances like the pandemic, but they don't scare us out of the market. As Peter Lynch said, and this is a quote, "I'm always fully invested. It's a great feeling to be caught with my pants up." And we agree with Mark Twain, who said, "Put all your eggs in one basket and then watch the basket." We're not diversified at all. We believe that owning a few great companies and stocks in great companies rather than owning a lot of mediocre ones. Same thing that Warren Buffett has said. And we don't believe in rebalancing. We want to let our winners run, and our losers we want to cut short. All that to say, I'm guardedly optimistic that 2021 is going to be a good year. 2018, 19, and 20 were very good years. I think that 2021 could follow on that. But we'll see. Two big questions. I started the program talking about two big questions. Two big questions that every investor wants to know. In fact, they're the same questions that every person close to or in retirement should be asking. And the first question is, will I outlive my money? Do I have enough to maintain my quality of life for the remainder of my life? And the second question is, how much risk will I be taking to reach that? And if you're still accumulating, still have not retired, rephrasing the question is, how much risk am I willing to take to reach my goal of having enough to retire? And if you're already retired, rephrase the question to say, how much risk am I willing to take to maintain the quality of life through my life? To the first question, how much do you need to be sure to maintain a quality of life and not run out of money? You know, coming out of the 1960s, 1970s, even into the 1980s, people talked about the idea of having 80% of your salary was going to be enough. But remember, in 1960, life expectancy was 69 years of age. My father, as he was approaching retirement time, 61 years old, looking at retiring, one of the options he had for his retirement fund was a 5-year annuity. 5 years. Saying, and he planned to retire at age 62, that annuity would have paid out until age 67. Incredible. You know, think about today's life expectancy. That was back in a time when most people, after they retired, a lot of people died shortly after. In fact, my father never did make it to retirement. He passed away 4 months before his 62nd birthday. If you look at where we are today, prior to COVID, going back to 2019, the life expectancy in the United States, if you were 65, was into your mid-80s. And if you were healthy, most people who are listening to this program are pretty healthy. Most of the people in their 65 are going to live into their mid-90s, and half are going to live longer. That means many people are going to live to age 100. And what that also means is that 80% number is really questionable. It's truly questionable. Does it need to be 100% or maybe as high as 130%? And if you plan on reaching 130%, and only really need 100%, you have money left over. But if you plan on 100% and really need 130, the only way to get there is a diminished quality of life. Isn't it better to err on the safe side rather than on the potential detrimental side? So then the question is, how much do you really need? You know, Fidelity says you need 10 times your current salary if you haven't retired yet. 10 times. I don't believe that. Very, very simply, if your ending salary is just $15 an hour up to $150, $15 you can make it, but more than that, you're going to be falling short. Now we're coming up to a commercial break. Don't go away, because I want to go back. How much do you really, really need? How much do you want to have going into retirement, and how much do you want to have to maintain quality of life in retirement? Those are key questions that we should be asking, you should be asking, we should want to know. So we'll be coming back after the commercial break. Also, you want to hear my guest after the commercial break, and I want to talk about the advertising rule. We've got all those things to cover, and I want to finish this. How much do you really need? Stay with me. We'll be right back after this commercial break. Don't go away.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So two key questions we're talking about. We're talking about the question, how much do I need to make sure that I don't run out of money at the end of my life? And how much risk am I willing to take? So I started to talk about Fidelity's approach is 10 times your current salary if you're not retired yet, 10 times your ending salary. I don't believe that's enough. If you look at what Social Security and 10 times the last salary is, for someone who's making $15 an hour, making $30,000 a year roughly, that will furnish 84% of your ending salary. Doesn't even get you to 100%, doesn't get you to 130%. If you're making $100,000 a year, if that's the ending salary, if you add Social Security and 10 times earning, or 10 times your last salary, that gets you only to 68% of income replacement, not even to the 80%, far from 100%, and half of what you need to get to 130%. If you're talking $150,000 annual income, Social Security plus 10% means you'll be at 62%. I mean, think of that. Only 3/5 of what you really need to get to 100%, and significantly less than half of what you need to get to 130. And all those numbers assume that you stay healthy until you die. All those numbers assume you're not going to experience significant medical costs, that you're not going to be in a situation where you need over and above standard medical treatment. The estimates are that 149 million Americans are underinsured or uninsured, but a number of those are older people who have maybe 10 times or 10 times what they ended with. That is a significant assumption. So we believe that most people are seriously underfunded as they go into retirement, and even in retirement may be seriously underfunded. If you've been listening to me for the last 9 years, I've been talking about beware, because the inflation rate began to rise in the 1960s, not in the 1970s. It was well on its way in the 1960s. And between 1962 and 1979, the dollar lost 70% of its purchasing power. Didn't happen overnight. didn't tick up a big bunch all at one time. It ticked up little by little each year, with two exceptions in the late 1960s when it dropped a little bit. But it began to creep up, and most people think of the oil crisis, and that pushed it up. But by that time, inflation was already 6 or 7% per year. Yes, it got into 17% before it was over with, but the dollar lost 70% of its purchasing power. The cost of living essentially tripled during that time. People living on fixed incomes saw a significant deterioration in their quality of life. And I believe there's a very reasonable expectation that we'll see that gradual rise in the next 15 years. And now is the time to begin to plan for it. If it does not happen, all you err is on having more money than you expect to need at the end of your life. That's not bad. If it does happen and you don't plan for it, you end up having a worse quality of life. Which brings me to the second question. How much risk are you willing to take? Total Risk, who put out that paper, says it has software to analyze the portfolio risk in a portfolio. I read the paper. I listened to the people who do Total Risk. I don't use it because a lot of it is focused on short-term risk rather than long-term risk. Posed on the risk you're facing today rather than long-term risk. And it is focused on volatility risk, not on credit risk, not on purchasing power risk, not on some of the risks that I think are more important. Let me give you an example. Suppose you have two portfolios. Each of those portfolios is $100,000. One is invested, or both are invested for 25 years. One is invested in T-bills. 3% is the long-term rate on T-bills. I know it's a lot less today, but suppose T-bills are paying 3%. That's the safest, right? That's the least volatility. And over 25 years, that $100,000 portfolio is going to grow to $222,130. On the other hand, a portfolio invested in the stock market at just 9%, and if you look at the last 11 years, the S&P 500 has been growing at 17%. That's not going to continue probably, but 9% is a nice safe number to use. That $100,000 will have grown to $862,310. So what appears to be the highest risk, the stock portfolio, turns out not to be the highest risk. What turns out to be the least risky, the short term, is in fact a higher risk because you have a quarter of the money after 25 years you do with the stock portfolio. If you need money short term, T-bills are the way to go. But this whole idea of compensating for short term risk is done at a loss of potential gain and increases long-term risk. We're focused on longer-term risk. Even if you're into your 60s and 70s and 80s, you should be thinking about longer-term risk rather than short-term risk. Yeah, it may be less volatile today, but will you have enough? Will you make it to the 130% that you need? You know, two big questions. How much do I need to be sure I don't run out of money in my lifetime? And my guess is if you have a financial plan, what that plan tells you is significantly lower than what you really need. I think you probably need a lot more. Just financial plans, and if you've been listening to the program, you know that I don't believe in financial plans. I believe that they're based on historical data. They don't take into account the black swans like the Great Recession and the pandemic or potential inflation coming in. They get shocked when that happens. Most plans don't plan for 130%. They plan for 100% or 80%. And most plans only figure you're going to live to the age of 100. And 30% of the people listening to this program are going to live longer than 100, in my estimate. So listen to the program. Listening to these programs, I have a great difficulty as a math major. I was a math major undergraduate. Mathematically, those financial plans are mathematically wrong. statistics that they'd use for Monte Carlo simulation and using the bell-shaped curve to estimate things are not real-life scenarios. They're wrong. They're wrong. Those are the problems I have with those financial plans. So the question is, how much risk is I'm willing to take? Don't confuse short-term risk with long-term needs. Don't plan for avoiding short-term volatility to give up on what you normally need. Most plans don't call for 100%. Most plans only figure for 100 years. Listen to my program, and you'll know that you need more money, and you need it for a longer period of time. Life is increasing ever so much every year. So the question is, how much risk am I willing to take? I think with a moderate portfolio or even a conservative portfolio, you can grow very significantly. Those are the two big questions. They're important. Focus on those questions. But the whole key is maintaining the quality of life, reaching the point as you retire to maintain that quality of life for the many decades which you have following it. And if you're in that period of time, to maintain your current quality of life. That's what it's all about. So with that, I want to introduce my guest today. She is Mary Copeland. Did I say that correctly? Of Compass and Clock. Mary, are you there?
I am here, and yes, you said my name correctly. Thank you, Mike.
Very often I mispronounce names, so I'm happy I got it right this time. So, Mary, let's start with your background.
So my background is in fashion buying and merchandising, which really has a lot to do with relationship building. And after 25 years of a very successful career, I then rolled into advertising and marketing. And I accidentally stumbled. And that's how I wound up where I am today, quite honestly, doing Compass and Clock, is through all of that.
So tell us, you named the company Compass and Clock. Tell us why Compass and Clock.
Because Compass has to do with navigation and guidance, which we all need from time to time. And clock signifies tick-tock, tick-tock. We're all aging at the same rate, one day at a time. So Compass and Clock is navigating life today to remain independent tomorrow.
Awesome. So tell us about the magazine and the online magazine. Tell us about the company. What does Compass and Clock do?
So Compass and Clock, I launched in January of 2018. Can you hear me?
Yes.
Oh, so in 2018, I launched Compass and Clock as a multimedia platform to honestly serve my neighbors and provide them with free information to help them navigate the road as we age. And I created it so that the adult kids and their parents can all have access to information and make decisions together. And so the magazine comes out twice a year, and I try to focus on topics of housing, healthcare, finance, legal, leisure, and family support. And the same magazine is cover to cover online on our website.
That's awesome. We're coming to a commercial break. Don't go away, because we'll be right back after the commercial break to talk about this in greater detail.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I want to finish talking about the advertising rule. Released last week by the Securities and Exchange Commission. It's 434 pages long. The most exciting and interesting read, it is not. But I read it all, and some of it twice. National Compliance Consultant, IA Compliance. They do conferences, they do consulting. They called me and they wanted to talk to me and maybe quote me in what they write up about the advertising rule, because I do report performance and I report it in a special way. They wanted to have my take on the whole thing. I don't know if I will be quoted. We'll see. They've got a thing coming out before the end of the month, and maybe it'll be there. But coming back to the rule itself, there's two key elements, in my opinion. One on reporting, on performance, and the other key element is on testimonials and endorsements. Both impact Adams Financial Concepts. Both impact, or at least one impacts most companies. And for those of us that report performance, it both will impact us. Now, for Adams Financial Concepts, we're still registered under the state of Washington. Firms with less than $100 million in assets are regulated by the state. Firms over $100 million are regulated by the Securities and Exchange Commission. Right now, we're at $85 million. I expect that by next year, we'll be an SEC-regulated company. And I did reach out to the state to ask them how they are going to handle the rules. So what I'm talking about is only for SEC-registered investment advisors for the time being. But I would imagine even the state of Washington will pick it up. So what does the rule say? It's important for you to better understand what advisors will do and the qualifications. So on the first question, performance. All those who present performance are going to be required to do certain things. First, they're going to be required to show not just 1 month performance, they're going to be required to show 1 year, 5 year, and 10-year periods versus an index. So that's if a firm's only been going or only reporting in certain aspects for 2 years, that's enough until they get to 5 years. But the idea is to give a longer history. You know, at Adams Financial Concepts, we give not just 1, 5, we give 1, 2, 3, 5, 7, 10, and since inception time periods. And the second thing we want is net performance after fees. I was a little disappointed in that they can exclude some fees, like custodian fees, so they don't have to reduce the performance by the custodian fees. And I'm sure that's going to lead to other fees they don't disclose or don't take into account. So they're going to overstate the performance by a bit. The Adams Financial Concepts performance is net of all fees and all expenses. It is the exact amount the clients have in their accounts. The third thing is the index. And while they have to compare to an index, it's almost better than it sounds, because there are now 13 million indices. 13 million. I was shocked. I did a program on it maybe a year or 2 years ago. 13 million different indices. I'm convinced that many companies or many managers, when they find that they're underperforming, they will invent a new index that they outperform at least for a period of time. But there's 13 million indices. For Adams Financial Concepts, we just use one, the Standard & Poor's 500 with dividends reinvested. It's the best known index. It makes the most sense, and it doesn't matter you're comparing what we're doing with the market itself, or what we consider the market. Third thing is they have to disclose material conflicts of interest. That makes sense. The next thing is they have to disclose potential for loss. You know, when you look at things, people will say past performance is no guarantee of future results, but they don't say there's a loss. You know, our disclosures say that we accept that there will be times when there will be periodic losses, setbacks, and unexpected occurrences like the pandemic and Great Recession. Calamitous drops do not scare us out of the market. We're going to invest all through those. There could be losses during those periods of time. They also have to disclose any material facts. You know, the fact is AFC accounts are fully invested. That's one thing we disclose. We say it's, as Peter Lynch said, it's a great feeling to be caught with your pants up. Up. Peter Lynch said that. I like that. EFC doesn't believe in rebalancing portfolios. We believe in letting winners run and cutting our losses short. And sometimes we're late in recognizing a loser stock. We disclose that. That's a material fact. And the next thing, you have to include all accounts in a category or model. In our case, we include all of our growth accounts that are equity accounts geared toward growth, and our profit-sharing accounts, our incentive profit-sharing accounts. We include those in a separate category. They're not included with the growth. And we include all of those accounts, no matter when they started, as long as they have more than 1 quarter of data, they're included. If an account is terminated, that is part of the data. You can't cherry pick accounts, and we've seen some cherry picking happen with some of the performance numbers. You have to include everything. So those are the things that are for everybody. They also included some special items for commingled funds. And there's a huge number of accounts where they commingle funds, where everything's poured into one specific account, and everybody gets a portion of that account. We keep every single account separate. So I didn't spend much time looking at all the requirements, but there are certain requirements just for those. There are also requirements for accounts which are based on models or hypothetical, back-tested accounts. There's additional requirements. Since ours are actual client accounts, they're not hypothetical, they're not models, they're not back-tested, they're actual results, and they're net of all fees and costs. I didn't pay a lot of attention to the models and hypothetical, but there are special things. I mean, the reality is the rule was 434 pages long, so you can tell it was pretty detailed. The next item was testimonials and endorsements, and they will be allowed. You can't cherry pick. You can't realize greater information, so they will allow compensated, cash and non-cash, but it has to be disclosed. And we do have clients we take to baseball games or lunches or theater or invested in some of their businesses. That has to be disclosed as non-cash contributions. There is a conflict of interest from that. You have to disclose whether a client is, or whether the testimonial or endorsement is a client or not a client. And you cannot edit. The key thing is it has to be the truth. And the whole focus of this is to give prospects more information to see if they truly are a fit for the advisor. I think all this is positive. I think that all fits into a category where clients can determine how well an advisor is doing, and they can actually see what clients and prospects think, both good and bad. The good, the bad, and the ugly may be showing up as reviews. Anyway, that wraps this up. We're off and running on the first of the year of 2021. I have a pretty optimistic outlook for this year. I hope you do too. And I hope you stay safe, and I hope you stay healthy, and take care of yourself, and look at how you can invest to maintain your quality of life. Until next Saturday, and next Saturday we will be back to talk about money. Do stay safe and healthy. Safe and healthy.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by About Money with Mike Adams on AM 1590. The Answer. For more information, click on adamsfinancialconcepts.com.
So I'm here with Mary Copeland of Compass and Clock, and we just started to talk about the company, the magazine, and so on. But you launched this magazine because of your own experience, right?
That is correct. My mother had Alzheimer's disease.
And what happened during that time?
When my mom was diagnosed in 2008, a few years later, she and Dad were asking my sister and I some questions. And I felt that I didn't know the answers because my head was in childcare. So I feel like as a family, the five of us made some poor decisions as to how to help Mom and Dad navigate their choices and even learn what they were. And it cost them thousands of dollars. And the last 5 years of my mom's quality of life, I felt could have been so much better knowing what I know now and didn't know then.
That's an important thing to realize. And I think that, Compass and Clock is certainly an awesome way for people to begin to understand what their parents are going through this whole process, and some of the parents to understand what they're going through. So tell us more about what you do with Compass and Clock.
What I do is I try to reach folks with educational articles, tips, tools, resources, and I try to reach them all in advance so that earlier on in life we can start thinking about our own journey and our own road ahead. So the adult kids, while they're helping their mom and dad, can also be planning for themselves. And should a crisis mode happen, if they had access to this information in advance, and say mom and dad needed to move out of their home because of a health requirement and have to go into an assisted living community, they need to know that there are waiting lists for 2 years. They need to know what the costs are of what it's cost to live there long term. So that is what I try to do through the magazine, through our monthly newsletter, through the podcast, through our Road Ahead episodes on BCAT, in-person events, and more.
So, but beyond the cost and the things, there are a lot of other issues that are involved too, right?
Oh, yes. Medicare, how do you, it's a little overwhelming. And most people think, oh, Medicare, 65, but you need to start looking into that a few years earlier than that. All the wills and probates and trusts, how can you, like you were talking about, how can you grow your money so that you can sustain the lifestyle that you want? What programs are out there for folks that maybe have a very limited income? Do they know about Meals on Wheels Kids App and other programs like that in the community? And then leisure activities. It's all about having fun too. It's not about growing old and being bored. It's about enjoying your lifestyle. So I always want to talk about leisure activities too.
That's awesome. So tell us about the electronic newsletter.
So once a month, I send out a monthly newsletter because the magazine only comes out twice a year, spring and fall. And our readers and audience need information all the time. So if somebody were to go to my website, compassandclock.com, they can subscribe to the newsletter, which is free. I only send it once a month. Nobody is ever solicited. I don't share the email list. And we provide articles throughout the year and events that are going on in the neighborhoods and the communities that people might want to attend, whether they be an educational seminar or a fun festival. And we also, if there's any promotions that anybody wants to share with me, maybe a community is waiving the pet fee, the pet deposit. We'll share savings. We'll pass those along to everybody too. So
you also do a number of seminars, right, and networking within companies and in groups, right?
Yeah, so once a month I have a Compass and Clock meeting that I call a networking and planning meeting because all the members of Compass and Clock are actually advertisers, but I don't like to call them advertisers because I want them all to feel like they have ownership in the company with me. So we get together monthly on Zoom so they can interact with each other, get to know each other, because you can't refer business to somebody you don't know. And then we plan together for upcoming events. So when you talk about in-person seminars or seminars online, those are things we discuss during our monthly Zoom call. Starting this month, Compass Points rolls out, which is the third Thursday of each month at 11:30. It's on Zoom, it's free, and it's live, so people can ask questions of the experts. So this month it will be financial health, and we'll have a CPA, a financial advisor, and an estate planning attorney, and we're going to help folks prepare for their 2020 tax return.
Awesome. Sounds great. So a lot of companies are beginning to realize with their 401ks, they're beginning to think about financial wellness in terms of 401ks. But going beyond that, you're available to do company seminars as well. Is that right?
Yes. So I have at my fingertips access to experts in all fields as it pertains to retirement and aging. So whether it's a healthcare provider, a financial advisor, an attorney, a Medicare specialist, etc. If any company wants to have one of my experts or our experts, a panel, for instance, do a free seminar for their group, we would be happy to, because our goal is to help educate the professionals and the public, because the bottom line is we're all the same people. Whether we're working or not working, we're all going to grow old. And if the professionals have access to the information, then they can do a better job helping their clientele or patients or residents.
And it's all about quality of life when you really think about it.
Yes, indeed, it is.
It's helping your parents' quality of life. It's you preparing for quality of life. It's all about that. So tell people how they can sign up for the newsletter or the.
You can just go to the website, www.compassandclock.com. You'll see it right at the bottom of the home page. It'll say subscribe here. Just click on that, and it will only ask you for your email address. And you'll start receiving the newsletter. The next one goes out Monday, February 1st.
So what if somebody wants to make a contribution to have some expertise, wants to become an advertiser? How would they do that?
They can, again, go to the website, www.compassandclock.com, and there's a tab at the top that says advertising, and there's information about what Compass and Clock is about. And if they feel that what we're doing here with Compass and Clock is a good fit for them, then I encourage them to reach out and contact me. All my contact information is on the website, email and phone, and we can have a conversation and get acquainted and get to know each other. And there's 3 criteria that I always look for in a professional, and that is they must be compassionate and really care about the people they serve. They need to be experienced, and they need to be professional, because it takes a village.
And for somebody that wants you to do a company for or a seminar for their company and talk about this, how would they contact you?
Same way, they can go to the website, or my email address is compassandclock, MC for Mary Copeland, @gmail.com. Anybody is welcome to reach out to me to ask me questions, see if I can help you with a seminar for your team. If you have a question about your mom and dad or yourself and you need to be connected, just reach out. That's what we're here for. It's about building relationships and helping our neighbors.
That's perfect, and that's great. And I really recommend, if you're listening to the program, do indeed go online, sign up for the magazine, browse through it and see what applies to you. There may be times when nothing applies. There may be times when everything applies. But this is a time in which you can help your parents. We live in a sandwich generation, many of us do, where we have parents that are still living and experiencing those issues of older age, and we have children or grandchildren as well. So it's worth spending some time looking at the newsletter, and to look at the newsletter, sign up. And if you have a special expertise, go ahead and think about advertising and becoming a donor of information. And if you have a business that you want to help your employees, I would suggest that you contact Mary as well. All that is kind of advertising. And we are coming to a commercial break. Thanks for being on the program, Mary, and look forward to hearing much more from you. In the meantime,
Thank you so much,
we're coming to advertising, the new advertising rule. I want to talk about that right after the break, so don't go away. It's 434 pages long. I read it all, and some of it I read twice. I think it's a really positive thing, and we're going to be talking about that just as soon as we come to this break. And if you missed part of this program, you can find it within a few days on YouTube. You can also check our website and find it on a podcast. Any past programs are also going to be on YouTube or podcast. So don't delay. Check them out. I'll be right back after this break.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts.